Hello everybody, my name is Mark. Welcome to another one of my investing videos, and in this video I'm going to talk a little bit about delta and why is delta important when you're trading option spreads. Now, when you're selling covered calls or cash secure puts or even the option caller strategy, you really don't have to worry about delta because you are going long on the stock, or in the case of cash secure puts, all you care about is the stock closes above the strike price of the put option that you're selling, or maybe you don't care if it goes below and then you're going to just buy the stock at that price. But when you're trading option spreads like what you see me doing here, buying calls and selling calls, absolutely yes, delta is important. And the reason why that is because all stock options have a delta. Now, when you buy a stock, you buy 100 shares of the stock. If the stock goes up $1, you make $100. If it goes up $2, you make $200. But with options, it's very different. And so, first of all, let me show you real quick what I did today. I did a rollout, or actually a roll up, and with my short call, and I bought to close my 111. Spent $176. It was going to expire on March the 1st. That would have been this Friday. And then I sold to open a 112, and I took in a nice credit of $30. So theta premium wise, I'm doing well, $206, and so that adds to my overall premium of $100. And but the thing that I want to show you is the delta here. And first of all, let's take a look at my position. Here's my position right here. I have one call option. This one is $105 strike price. It expires in 2021 January. It's a leap, 2 years away. And I also have a 110 call option. Same thing, leap, expires in 2 years, 2021 January. And currently I have a short call. This is my 107, and this expires on March the 8th. That's a week from this Friday. And then I have another call, and this is the one I just rolled up. Just did it yesterday. And this one right here, it expires on March the 15th. So you can see that I'm laddering my profits. I'm laddering my expirations, and I did a video on that. If you want to, you can sell all the options that expire in the same week if you just want to do that. But when I have multiple options, I like to ladder them. That way every week I have an option expiring, and it just makes it easier for me to manage it, and also it saves a little money in commission too. Instead of doing rollouts every week, you're doing it every 2 weeks, and that cuts your commission in half, and that's kind of nice. So those are my positions. So I got 4 of them. I got a 105 call, a 110 call, and those are my long leaps. And then I got a 107 call and a 112 call, and those are my short calls, and those are my weeklies. So let's take a look at the delta on these, and you're going to see very quickly why the delta is important. Okay, so first let's look at the delta on the leaps. So let's go ahead and go to the Greeks. Delta is an option Greek, and here's a delta. Now, delta is an option Greek that tells you how much the option is going to go up or down in value if the stock goes up or down in value. So in the case of a call, let's look at let's look at the 105, and let's go to January. So here's the 105 right there. And let's go to the delta, and there's the delta right there. So delta is at 0.64. That means $64. That means every dollar that Microsoft goes up, then this call will go up. So right now the bid is 1910, the ask is 1990, so let's say 1950, and right now Microsoft is 112.36, so if it goes up to 113.36, then this is going to go up $64, which would put the bid like at 74 or something, and the ask would be like 2054, I think, if my math is working correct. And so that's how the delta works. So delta is just tells you how much the call or the put, how much the option is going to go up or down in value. If Microsoft were to drop back down, then that means this call were to drop back down. Okay, now remember my 4 positions. Okay, I have a 105 call and a 110 call, and I have a short 17 call and a short 112 call. Okay, now the 107 call was a weekly call that I sold on the 105 to kind of hedge the 105. Now let's look at the delta on the 107 call. So this 105 call is for January, so now I'm going to go to March the 8th. That's when my 107 expires. And I have to go in the money. So let's go in the money and let's look at the 107 delta right there. And it looks like we've got a big high 91, almost $92 delta. So that means I have a 64 and a 92. Let's round it up. So 92. So that means that I am negative 28 delta. Why am I negative 28 delta? Because my long call has a 64 delta. That means when you go long, you want the stock go up. But my short call, this one right here, is a 91 delta. It means I want the stock to go down. So since this is a higher delta, my short delta is higher than the long, and that means if the stock goes up, I'm going to lose $28 on this particular position. Now, delta doesn't matter. If Microsoft would just settle down and stop going up, then I'd be fine and I'd make money in the premium, right? But Microsoft has been going up like crazy, and so I have to keep an eye on the delta, and if it goes up too high and my delta gets away from me, then I have to roll it out, because it doesn't make sense to roll out these 107s and make $20–30 if Microsoft's gonna go up $2 or $3 and I'm losing $60 or $90. You know, that doesn't make financial sense now, does it? Right? So you have to keep an eye on the delta, and if you see delta getting away from you and you see like this negative 28, then it's time to make a change. So there's some different things that I can do. And first of all, let me go over my second one. Okay, let's look at remember I have a leap 110 and then I have a short 112. So let's look at my 110. Here's my 110, and that delta is right now at a 59 and a half. And let's look at my short 112, which expires on the 15th. And let's go down right here, and that's at a 53. So I'm actually, what did I say? So 53, and this 110 delta was a 59. So I'm actually positive delta. So that's good, okay? And that's because I did a rollout, and that's part of the reason that I did a rollout. Because I initially bought that 110 call because at my 105 call the delta was getting away from me. And again, you know, these diagonal spreads, these spreads that I'm doing, okay, it's not like normal option trade, you know, or even normal investing when you're just buying stock or mutual funds. You have to keep an eye on these Greeks and these delta, and that's pretty important when you're doing spreads, because when you're doing a spread, you're buying calls, you're selling calls, you're buying puts, you're selling puts. Every single call option, put option that you buy and sell is going to have a delta. So when you are buying calls and selling calls, you have to pay attention to the delta, because, you know, I have a 105 call, but then I sold a 107. Now, what happens if Microsoft goes to 120? Well, whoop-de-doo. You know, I can close this 107 and maybe sell a 108, and I don't even know if I could even take it. I don't even think I could roll it up to 108 or anything without having to give away 2 or 3 months to get any premium. And so if I'm losing $28, you know, and right now Microsoft's at 112, you know, then that's $200 in the hole. So you're going to see this account value go down to $33,300, and I don't want that. So I have to pay attention to these deltas. So what can you do if delta gets away from you and you're doing a spread like this? How can you manage delta? You have to manage delta. You can't just manage options. You can't just pay attention to premium and roll down and all that stuff. You got to pay attention to delta. Okay, well, one of the things that I could do is I could just close the entire trade and take my profit, or if I take a loss, I take a loss, I don't know. I think I'm still in the red. I probably at some point I need to go over the entire. This is my entire transaction history. I started all of this nonsense back on February the 4th. I started out buying a call and I sold the open this 106, and that one went well. Bought it back for $5, made $78. Then I sold the open this one, made $127, and I thought I was doing pretty good. But then Microsoft went up, and so I decided to buy it back for $320. Sold the open another 105, made $30, and Microsoft kept going up. So I bought that one back for $5.94, and I took in a debit, right? And those debits is one of the little alarm bells. Like when you're taking in debits, then that's like a little clue that maybe the delta's getting away from you, and it's time to make a change in your option strategy. So one of the things that I could do is I could close the whole trade, add up all those red numbers, add up all those green numbers, and chalk it up as a win or a loss. I'm pretty close to broken even. I might be up a little bit, but I think I'm about broken even because of the delta. Even though I'm making good money in premium, the delta's kind of getting away from me. So one of the things that I could do is I could close all of this, right? I could sell to close these leaps, and I could buy to close these shorts, and then I could just maybe buy a 115 and just start afresh, right? Buy a 115 call. So it looks like the 115 call, the bid is 1430, the ask is 1455, and then start selling some short calls like this 9 days out. The 115 looks like I can get about 40 bucks. That's not bad. $40, that's about $120 for 9 days. That's about $120 a month. That's not bad at all. And so if I'm making $120 a month, then this call right here will get paid off in a year. I'll make my premium, and this call expired, and then I'll have a year to go. So I could do something like that, just close the whole thing and start fresh. The second way that I can manage the delta is what you've been seeing me doing: buy to close these shorts. Let me go back to my account page. Close out, buy to close this, and sell to open a 108 or a 109, and I'd be taking debits, but at least I could keep up with the delta. And same thing with this one, buy to close this one, and I actually did that yesterday, and I bought to close a 111 for like 170, and I sold to open this 112, and that put me in a positive delta. But overall, I'm down 28 delta on this. I'm up 6 delta, so I'm still $22 negative delta. So I really don't want to see Microsoft go up too much. For me, I would like to see Microsoft just kind of calm down and settle down and have some of these options expire so I can sell some more and I can make some premium. This diagonal spread stuff that I'm doing, buying the leaps and selling the weeklies, the ideal scenario is a neutral. It's a neutral strategy, and the best case situation for me is for Microsoft just to calm down and stop going up the way it's been going. It's been on a real tear. If you look at Microsoft here, let's go ahead and go to the 1 month chart. This is a 1 month chart. Look what it's been doing. It's way up. It's way up its resistance, and let me close all this out and we go to the 6 month chart. I'll tell you, if I see Microsoft break out of that and I see it go up there somewhere, then I'm really going to probably do some major changes in my little option strategy here. I certainly didn't expect any of this, but one thing about all of this is you got to expect the unexpected. You got to be prepared. You got to have backup plans. You got to have a plan A, a plan B, and a plan C, and maybe some other plans behind that, right? So you always got to pay attention to delta. And there's one more thing that you can do to manage delta. So the first thing is to close the whole trade and start a new trade. The second thing you can do is buy to close your shorts, sell to open higher shorts, and you might take a debit, but at least you'll get your delta down to a manageable size, because your higher options will have lower delta, and that'll put it back into favor. And the third thing that you can do, and this one is what I'm probably going to do, is I'm just going to buy another call option, and I'm going to buy that 115 call, and I'm going to sell to open a 120. This is actually my plan. If I see Microsoft go up to 114, then that's going to put me down about $60 in delta, and my account will go in the red. I'll probably go down to like $440 there. And if that happens, I am going to buy to open a leap call, This is my plan, and my plan changes all the time, but I'm going to buy this call right here, this 115, and I'm going to spend, it'll probably be up to close to $1,600 by then, if it does go up that high. And then I'm going to sell to open some $120 calls. And if I look at the $120 calls right now, and I'm going to sell it the following week. That way I have one short expire in the 9 days. That's my 107. And then I have this short expire in 16 days. That's my new 112. And then I'm going to have this 115. And then I'm going to sell to open a 120, expires in 23 days. And let's look at what I would get in premium for that. And it looks like I would only get, right now, I would only get about $14, $15. But if it went up to, if Microsoft went up to 114, then this would be close to $40, and that would be my new game plan. I'd have a third option, and then my delta would be under control, and hopefully I can hold on to that new position, collect some premium, watch some of these expires, or at least I'd be able to roll them up at credits again and quit eating into my premium, you know. And hopefully in a couple years I can make some money. My target, as I've been saying, I'm trying to make 30%. So that's why I'm doing all this. I mean, the safe and sane thing is just to stick with one call option and just keep rolling it up, rolling it up. But I would actually like to make a better return. I would like to I'd like to have a better return than what I did last year. I had a decent return last year. I had 16%. But I want to have a great return. I want to try to get the 30% return. And I'll just close this video on something that I say all the time. I really like this diagonal spread strategy. I mean, if you were to do an option trade like this, and and Microsoft were to stay flat, and you would buy, let's say, this 115 call, and then you were just to sell to open a 115 call, and you're making $40 a week. Well, 688 days, that's what, like 98 weeks, something like that, 98 weeks. So almost 100 weeks. So that would be a $4,000 profit on a $1,450 investment. So there is great potential to make some great returns. But you do have to manage this option trade, and you got to be on it like a hawk. And if you see something go haywire, if Microsoft goes up, Delta starts going against you, or the other problem is Microsoft could go down, and now I would have a Delta going the wrong way, the opposite way. But that's a little bit easier to manage because I could just sell to open lower call strikes. But when it starts going up, you really have to think about, how do I want to manage the delta? Do I want to buy more calls? Do I just want to roll up the calls that I have? Or maybe I should just get out of the position and just do a reset, start the whole thing over. So it's really up to you and your personality, the way that you want to manage the delta, the way that you want to manage these spreads. But I really like these spreads. I've had lots of good luck in my option trading life with these spreads, and I'm going to stick with it. And we'll see what happens as time goes by, and we'll see in the next few days, next couple weeks, and what if I need to do something. But you know, the aim of the game is to make a little bit of money, right? So hopefully you enjoy this video. As always, if you have any questions or comments, feel free to leave a comment. Always appreciate any feedback. If you want to subscribe, that's good too. So that's it for this video. Thank you for watching. I'll see you in the next video.